Critical Command Pictures presents the Forex video training series, Black Belt, 4th Degree, Stop Loss. Let's face it, the market will always do what it wants to do and move the way it wants to move. Every day is a new challenge, and almost anything from global politics, major economic events, to central bank rumors can turn prices one way or another faster than you can snap your fingers. This means that each and every one of us will eventually take a position on the wrong side of a market move. Being in a losing position is inevitable, but we can control what we do when we're caught in that situation. You can either cut your loss quickly, or you can ride it in hopes that the market will move back in your favor. Of course, the one time that it doesn't turn your way could blow out your account and end your budding trading career in a flash. The saying, "Live to trade another day," should be the motto of every trader on Newbie Island, because the longer you can survive, the more you can learn, gain experience, and increase your chance of success. This makes the trade management technique of stop losses a crucial skill and tool in every trader's toolbox. Having a predetermined point of exiting a losing trade not only provides the benefit of cutting losses so you may move on to new opportunities, but it also eliminates the anxiety caused by being in a losing trade without a plan. Less stress is good, right? Of course it is. So let's move on to different ways to cut them losses quick. Now, before we get into stop loss techniques, we have to go through the first rule of setting stops. Your stop loss should be the invalidation point of your trading idea. When the price hits this point, it should be a signal it's time to get out, buddy. In the next session, we'll discuss many different ways of setting stops. The 4 methods you can choose from are equity stop, volatility stop, chart stop, and time stop. Ready? Good. Let's get started. The equity stop. Let's start off with the most basic type of stop, the equity stop. This is known as the percentage stop because it uses a predetermined portion of the trader's account, say 2%, if the trader is willing to risk on the trade. The percentage risks vary from trader to trader. More aggressive ones put up to 10%, while the less aggressive ones usually have less than 2% risk per trade. Once the percentage risk is determined, the trader uses his position size to compute how far away he should set his entry. This is good, right? I mean, a trader is putting a stop, which is in accordance with his trading plan. This is good trading, right? Wrong. You should always set your stop according to the market environment or your system rules, and not how much you want to lose. We bet you're thinking right now, huh? That doesn't make any fucking sense. I thought you said we needed to manage risk. Yes, we agree this sounds confusing, but let us explain. You remember Newbie Ned from your positioning size lesson, didn't you? Newbie Ned has a mini account with $500, and the minimum size he can trade is 10,000 units. Newbie Ned decides to trade the pound dollar, and he sees resistance at 1.5620 has been holding. As per his mismanagement rules, Ned will risk no more than 2% of his account per trade. At 20k units of pound dollar, each pip is worth $1, and 2% of his account is $10. So by the largest stop Ned can put is 10 pips, which he's decided to on his trade, putting his stop at 1.5630. 10 pip stop, just above resistance. But wait, pound dollar moves over 100 pips a day. He could easily get stopped out the smallest move of pound dollar. Because his position limits of his account is set to, he is basing his stop solely on how much he wants to lose instead of given market conditions of the pound dollar. Let's just see what happens next. And bam, Ned got stopped out right at the top because his stop loss was too tight. And aside from losing trade, he missed out on a chance to grab over 100 pips. From that example, you can see the danger using equity stops is that it forces the trader to set a stop at an arbitrary price level. Either that stop will be located too close to entry, like in Newbie Ned's case, or at a price level that doesn't take technical analysis into account. For all you know, you could be setting your stop right at the level where price could turn and head your way. Who hasn't seen that before? But because you already got stopped out, you wouldn't be able to bag those pips. God damn it. The solution for Ned is to find a broker that suits his trading style and starting capital. In this case, Ned should trade with a broker that allows him to trade micro or even custom lots at 1,000 of pound dollar, each pip is worth 10 cents. In order for Ned to stay in a trade with his comfort level, he can set a stop on the pound dollar to 100 pips before losing 2% of his account. Now he has the ability to set a stop to the market environment, trading system, support and resistance, etc. The chart stop. A more sensible way to determine stops would be based on what the charts are saying. Since we're trading the markets, we might as well set our stops on what the markets are showing us. Makes sense, right? One of the things we can observe in price action is that there are times when prices can't seem to push or break beyond certain levels. Oftentimes, when these areas of support and resistance are retested, they could potentially hold the market from pushing through once again. Setting stops beyond these levels of support and resistance makes sense, because if the market does trade beyond those areas, then it is reasonable to think that a break of the area will bring in more traders to play and break the further push of your position against you. Or if these levels do break, there may be forces you're unaware of suddenly pushing the market one way or another. Let's take a quick look. Set your stops based on support and resistance. Where would you place your stop? On the chart, you can see the pair is now trading above the falling trend line. You decided this is a great breakout trade setup and you decide to go long. But before you enter the trade, you stop and ask yourself some questions. Where could you possibly set your stop? What conditions would tell you when the original trade idea is invalidated? A stop below 1.2800 would be ideal. In this case, it makes the most sense to set your stop below the trend line and support areas. If the market moves into one of these areas, it means that the trend lines drew no support from buyers, and now sellers are in control. Your trade idea was invalidated, and it's time to suck it up, exit the trade, and accept the loss. The volatility stop. To put in simple terms, volatility is the amount a market can potentially move over a given time. Knowing how much a currency pair tends to move can help you set up the correct stop-loss levels to avoid being prematurely taken out of a trade on random fluctuations of price. For instance, if you are a swing trader and know that the euro-dollar has moved around 100 pips a day over the past month, setting your stop to 20 pips will probably get you stopped out too early on some small intraday move against you. Knowing the average volatility helps you set your stops to give your trade a little breathing room and a chance to be right. As we explained in a previous lesson, one way to measure volatility is by using Bollinger Bands. You can use Bollinger Bands to give you an idea of how volatile the market is right now. This can be particularly useful if you're doing some range trading. Simply set your stop beyond the bands. If the price hits this point, it means volatility is picking up and a breakout could be in play. Place your stop past the Bollinger Bands. Another way to find the average volatility is using the average true range ATR indicator. This is a common indicator that can be found on most charting packages, and it's easy to use. All the ATR requires is that you put the period, the amount of bars, candlesticks, or time that it looks to calculate the average range. For example, if you're looking at a daily chart and you input 20 into the settings, the ATR indicator will magically calculate the average range of the pair of the past 20 days. Or if you're looking at an hourly chart and you input 50 into the settings, then the ATR indicator will show you the average movement of the last 50 hours. Pretty sweet, huh? You can also use the ATR to help you place stops. This process can be applied by itself or as a stop or in conjunction with other stop-loss techniques. The point is to give your trade enough breathing room for fluctuations here and there before it heads your way, and hopefully it does. The time stop. Time stops are stops based on a predetermined time in trade. It could be a set time, open limit time for hours, days, weeks, etc. Only trade during a specific trading session. The market's open or active hours, etc. For instance, let's say you're an intraday trader and you put on a long trade here on the Euro Swissy and it hasn't gone anywhere. We're talking real fucking snoozeville. Why keep your money locked up in that trade when you can use it to take advantage of this one? More movements, more pips, yeah. Because your predetermined rules for the fact that you do not like to hold trades overnight, you decided to close your position at 4 p.m. and you're usually done for the day and go off to your bi-weekly World of Warcraft raid. Or maybe you're a swing trader and you decide to close your positions on Friday to avoid gaps and weekend event risk. Also, having some margin tied up in a dead trade could be cost you an opportunity for another great trade set up somewhere else. Set a time limit and cut off that dead weight so the money can do what it is meant to do, make more money. The top usage mistakes. In this section, we'll talk about common mistakes traders use when using stops. Sure, it's one way to practice proper money management, but when used incorrectly, it could lead to more losses than wins, and you don't want that, do you? Placing stops too tight. The first common mistake is placing stops tighter than those leather pants that they used to wear back in the retro days. They're so tight, there ain't no room to breathe. In placing ultra-tight stops on trades, there won't be enough breathing room for the price to fluctuate before ultimately heading your way. Always remember to account for the pair's volatility and the fact that it could dilly-dally around your entry point for a bit before continuing in a particular direction. For instance, let's say you went long pound yen at 145 with a stop at 144.90. Even if you are right in predicting the price would bounce from that area, it's a possibility that the price will still dip 10 to 15 pips lower than your entry price before popping higher, probably until 147. But guess what? You weren't able to rake in that 200 pip profit because you got stopped out in a jiffy. So don't forget, give your trade enough breathing room and take volatility into account. Using position size as a basis for stops. We mentioned this earlier in a lesson. Using position size instead of technical analysis to determine stops ain't such a good idea. We learned from that newbie Ned, remember? As we discussed, using position size to calculate how far your stop has to be has nothing to do with the market's behaving. Since we're trading the market, it'd make much more sense to set stops depending on how the market moves. After all, you picked your entry point on targets based on technical analysis, so you should do the same for your stop. Position size should depend on your stop loss. We're not saying you should forget about position size completely. What we're recommending is that you should decide where to place your stops first before calculating your position size. Since traders make the mistake of setting stops way too far, crossing their fingers that the price action will head their way sooner than later. Well, what's the point of setting stops then? What's the point of holding on to a trade that keeps losing and losing and losing when the money can go to a more profitable one? Setting stops too far increases the amount of pips your trade needs to move in your favor to make the trade worth the risk. The general rule of thumb is to place stops closer to the entry than profit targets. Of course, you'd want to go for less risk and a bigger reward, right? With a good risk-to-reward ratio, say 2 to 1, you're likely to end up with more profits than if you're right on the money if you win your trades at least 50% of the times. Placing stops exactly on support and resist levels. Setting stops too tight, bad. Setting stops too far, bad. Where exactly is a good stop place then? Well, not exactly on support and resistance levels, we can tell you that. How come? Didn't we just say technical analysis is the way to go in determining stops? Sure. It's helpful to note nearby support and resistance levels when determining where to place your stops. If you go in long, you can just look for a nearby support level below your entry and set your stop in that area. If you're going short, you can find out the next resistance level above your entry and put your stop around there. But why isn't it a good area to put it right smack on the support resistance level? The reason is the price could still have a chance to turn and head in your direction upon reaching that level. If you place your stop a few pips beyond that level, you're more or less sure that the support resistance level is already broken, and then you can acknowledge that your trade idea is wrong. How to execute the stops. Once you've done your homework and created an awesome trade plan that includes a stop out level, you now have to make sure you execute those stops if the market goes against you. There's 2 ways to do that. One is by using an automatic stop, and another through a mental stop. Which one is best suited for you? Here's where the hard part comes in. To answer this question lies in your level of discipline. Do you have the mental toughness and self-control to stick to your stops? In the heat of battle, what often separates the long-term winners from the losers is whether or not they can objectively follow their predetermined plans. Traders, especially the more inexperienced ones, often question themselves and lose that objectivity when the pain of losing kicks in and brings in negative thoughts like, maybe the market will turn right here. I should hold on a bit longer, and then it will go my way. If the market has reached your stop, there's no reason for the trade is no longer value and it's time to close it out. No fucking questions asked. This is why the almighty Forex gods invented limit orders. New traders should always use limit orders to automatically close out losing trades at predetermined levels. This way you won't give yourself a chance to doubt your plan and make a mistake. You won't even have it be sitting in front of your trading station to execute the order. How awesome is that? Of course, the more trading experience you have under your belt, the more you hopefully have a better understanding of market behavior, your methods, and more disciplined you will be. Only then would mental stops be okay to use, but we still highly recommend limit orders to exit the majority of your trades. Manually closing trades leave yourselves open to making mistakes, especially during unforeseen events, such as entering the wrong price levels or position size, a power outage, a coffee binge-induced bathroom marathon, etc. Don't leave your trade open to unnecessary risks, so always have a limit order to back you up. Because stops are never set in stone and you have the ability to move them, we'll end this lesson with the do's and don'ts of moving your stop. Don't let emotion be the reason to move your stop. Like your initial stop loss, your stop loss adjustment should be predetermined before your trade is on. Don't let panic get in the way. Do trail your stop. Trailing your stop means moving in the direction of a winning trade. This locks in profits and manages your risk if you want to add more units to your open position. Do not widen your stop. Increasing your stop only increases your risk and amount you will lose. If the market hits your planned stop, then your trade is done. Take the hit and move on to the next opportunity. Widening your stop is basically like not having a stop loss at all. It doesn't make any sense to do it. Never widen your stop. These rules are pretty easy to understand and should be followed religiously, especially rule number 3. Want me to repeat it again? Do not widen your fucking stop. Always remember to trade your plan and figure out what to do in each scenario so that you won't panic and do something you'll probably regret later on. The summary. Now let's review the things you need to remember about setting stop losses. Find a broker that allows you to trade in position sizes that suits the size of your capital and risk management rules. We always use the word predetermined a lot in this lesson because you should always know when to get out when you open a position. Once you already are in a trade and it's turned into a loser, you lose the ability to make a decision to exit the trade with a clear head. This could be very bad for your account balance. Set stops to the current market environment, framework, or trading method. Do not set your exit levels on how much you are willing to lose. This market does not know how much you have or how much you're willing to use. Quite frankly, it doesn't fucking care. Find the stop levels that prove your trade wrong first, and then manage your position size according to it. Use limit orders to close out your trades. Mental stops should only be used by those with 1 billion trades recorded in their trade journal. Even then, limit orders are still the way to go. Emotionally unbiased and can be automatically executed while you're taking in some sun on the beach, sipping on margaritas. Only move your stop in the direction of your profit target. Trailing stops are good. Widening stops are very, very, very bad. Like anything else in trading, setting stop losses is a science and an art. Markets are dynamic, volatile as well. Volatile and a rule or condition that works well today may not work well tomorrow. If you continually practice the correct way to set stops, record and review your thought process, and trade outcomes in your journal, then you'll be one step closer to becoming a professional risk manager and professional trader.